Roth IRA conversions can be a very helpful tax planning maneuver for you in your retirement years, but we need to proceed with caution because when you execute a Roth conversion, it's a taxable event. And for a lot of people that do this, they do it somewhat haphazardly and it comes with several unintended consequences. So what we're going to do in this video is go through a hypothetical example of a couple transitioning into retirement that executes Roth conversions, and we'll go through the 4 most common unintended consequences that you need to be aware of before you do this on your own. So to get us started, a little bit of background about our fictional couple. It's my favorite fictional couple of all time, Jerry Seinfeld and Elaine Bennis. We're going to assume that Jerry and Elaine are 63 years old and have just transitioned into retirement. They're not collecting Social Security yet. They plan to wait until they're 67 or 70 to collect Social Security. They need money every month to pay the bills, buy groceries, entertainment, all that fun stuff. Their money is split between a taxable investment account and a couple of different workplace 401ks from their prior employers. Their plan for the moment is to take money out of the taxable accounts first and allow those tax-deferred retirement accounts to continue to compound. Generally, the math on that makes it more favorable to do so. Now, that being said, you might be aware that they're going to have to start taking money out of those 401ks and IRAs when they get into their mid-70s. When they do, that's all going to be considered taxable income. Over the years, that can push them into higher tax brackets, which is why Roth conversions could be an opportunity for them. This is what an average return scenario looks like for Jerry and Elaine, assuming they do no Roth conversions at all. As I mentioned, they have their money split between a taxable investment account and a number of tax-deferred 401ks and IRAs. They've got about $800,000 in the taxable account, a couple million in the tax-deferred IRAs and 401ks. What we've told the program is everything there is to know about Jerry and Elaine's finances, including how much needs to come out of the accounts on a monthly or quarterly basis to pay for living expenses, what their tax situation is, and the like. And what we're looking at here is a projection of what their annual portfolio balance would be with all those factors incorporated if they get average annual returns, the long-term average return out of their portfolio every single year. Now, you and I should definitely know that we are probably never going to get the long-term average. Some years are going to be much better than the average. Some years are going to get much worse when the market's correct. This will go up and down over time. But just as a base case to get us started, it looks like they're in pretty good shape from the perspective of not running out of money and having a pile that's big enough to support their future expenses. Now, from a cash flow perspective, what we see here is that in these first few years after retirement, they have money coming out of the taxable account first to pay for their expenses. That's what this yellow colored column is. And then at some point, and we've just started here with age 67, Social Security benefits will start coming in, which means that they simply need to take less out of their taxable accounts. And when the colors turn from yellow to orange, this indicates when they first need to start taking money out of those tax-deferred accounts to satisfy the minimum distribution requirements. And as you can see, they're forced to take out a larger and larger portion of these accounts as time goes on. Well, the reason that Roth conversions are often a compelling strategy is that if we look at their tax brackets over this time period, in these early years, they have money that can come out of the taxable accounts. That can be a combination of dividends that accumulate throughout the year, long-term capital gains, maybe some losses that they can harvest. And after we add up their income and take the standard deduction of $30,000, which is what it will be for Jerry and Elaine, they don't have a whole lot of taxable income left. They have a modest amount of income. They're in a lower tax bracket, but by deferring the distributions from the 401k and the IRA, those accounts will be larger when they do need to take from them and likely push them into higher brackets when they get older. Now let's compare this to what it looks like if they proceed with some Roth conversions. And what we've told the program here to do is assume that they convert enough, they take enough money from their traditional IRAs and 401ks each year for the next 5 or 6 to fill up the 22% tax bracket. and pay more tax now in exchange for a lot less tax later. And so what we can see here is in the average scenario, the average return scenario, which again is not going to happen, but it's just a starting point, they wind up with a much larger portfolio value than they would have by not doing these conversions. And from a cash flow perspective, they need to take more out of the accounts in the early years because they need to pay tax on those conversions. But the magnitude of increase of these orange columns is a lot smaller. The orange columns are not nearly as high as they were before we triggered these Roth conversions. And from a tax perspective, you can see here that in these early years, by doing the conversions, they're paying more in tax than they would otherwise. And you can see that the columns go right up to that blue line. That's the indicates the top of the 22% bracket and bottom of the 24% bracket. But then later on, they don't ever exceed this green line, which indicates the 32% bracket. And if we add up the total cumulative taxation over the rest of their lives, if they both live to age 100, they'll pay about $2.7 million in total income taxes over the next 37 years, which is a lot of money, but it's a heck of a lot less than it would have been had they not done the Roth conversions. They're saving up to $1.8 million over the next 37 years if this works out according to our assumptions. Now, again, it's not a free lunch, right? They're paying more tax in these years than they need to. If they choose not to do this, they're paying a lot less tax in these years, and they're making up for it over here. The first unintended consequence here has to do with how your Social Security benefits are taxed. So if you're someone who's receiving Social Security benefits, the amount that you're taxed on those benefits depends on what's called your provisional income. Your provisional income, basically you add up all your gross income, not counting the Social Security benefits. You add to that tax-exempt income that you might be receiving from interest on municipal bonds, perhaps, or a variety of other types of investments. And then you add to that 50% of your Social Security benefit. That's your provisional income. And if your provisional income is under $25,000 as a single tax filer, then none of your Social Security benefits will be counted toward your taxable income. If your provisional income is between $25,000 and the next bracket, which is $34,000, then up to half of your Social Security benefits will be taxed as income. And if you're over that top bracket of $34,000, up to 85% will be counted toward your income. So sometimes what happens here is if you're someone who is in the lower provisional income brackets and you think that the Roth conversion might be a good idea, that might still be a good idea for you, but you should understand that if you do too much of it, any amount that you convert into a Roth IRA from a traditional IRA or 401k counts toward that provisional income. And it could mean that more of your Social Security benefits are going to be subject to taxation if you fall into one of those higher brackets as a result. The second unintended consequence from Roth conversions has to do with long-term capital gains and dividends. So in our example, we're assuming that Jerry and Elaine are a few years away from filing for Social Security. They're going to be taking money out of this taxable investment account every month or every quarter probably to buy groceries and pay their household expenses. Now, in a taxable investment account, it might be titled in Elaine's name or Jerry's name or jointly, or maybe in the name of a revocable trust. Jerry and Elaine, as a married couple, are responsible for paying the tax on all the activities in that account every single year. If they have short-term capital gains or interest that accumulates from bank holdings or bond interest or anything of the like, those sources of income are taxed at their ordinary tax rates. And we're assuming that they're not going to have a whole lot of income. They might pay 10% or 12% because of their marginal tax rates in these first few years. But for long-term capital gains, which are gains on investments held for longer than 1 year, and qualified dividends means dividends from stock of publicly held corporations that adhere to a couple IRS rules, those types of returns are taxed at lower rates. And for Jerry and Elaine, federally, rather than paying 10% or 12% their level of income as they would on a short-term capital gain, long-term capital gains are going to be taxed at lower rates, maybe even 0%. So there are three federal tax brackets for these types of returns: 0%, 15%, and 20%. And the bracket that you're in depends on your income. So if Jerry and Elaine choose not to do Roth conversions, they're probably going to be in the 0% tax bracket here for the first couple of years at least. It means they can sell long-term investments, collect qualified dividends from their taxable account, free of any federal tax. They might be paying state taxes. That's a different story. The treatment of this kind of income depends on a state-to-state basis, depends on your state's rules, but federally, they might not be paying anything. If they proceed with this Roth conversion strategy, they'll have more income and will likely be in the 15% bracket. So it'll still be lower than their marginal tax rate, their marginal tax bracket at that time. But for a lot of people, it is an unintended consequence of Roth conversions. And if you're someone who is taking money out of your accounts from taxable accounts and harvesting long-term gains to do that, that is something to be aware of. So to put this in perspective, if Jerry and Elaine choose not to proceed with any kinds of Roth conversions, they'll have a modest amount of income and they'll be in a lower bracket. They'll have interest from bank account holdings, they'll have interest and dividends and capital gains potentially in their taxable investment account, but that'll be about it. And after taking the standard deduction this year, which will be $30,000 for Jerry and Elaine, they'll have a modest amount of income and find themselves in these lower tax brackets, which means that they'll be in the 0% long-term capital gains and qualified dividends bracket. Now, if they choose to proceed with the Roth conversions that we modeled out and displayed here a minute ago, they'll be converting enough to put their taxable income right here at the top of the 22% bracket. The top of this bracket in 2025 ends at $206,700 of taxable income. They're going to be right about there to maximize these long-term benefits of the Roth conversions. But by doing so, they'll be pushing themselves up into the 15% bracket here for dividends and long-term capital gains, and we need to be aware of that. Now, unintended consequence number 3 has to do with Medicare. For Medicare, if you're 65 or older and you're already on Medicare, you probably know this, you pay out of pocket for parts B and D. Part B, that's paying for your relationship with your primary care physician and a few other things. Part D is prescription drugs. You pay for that. This year in 2025, the Part B premium is $185 a month, unless your income is above certain thresholds. These are called the Medicare premium surcharges. And if your income is above certain levels, you will have to pay an extra amount towards your Medicare premiums. Now, the catch with this one that trips a lot of people up is that if your income in 2025 is above one of these thresholds, you're not going to pay this surcharge in 2026. There's a 1-year gap. You're going to pay the surcharge in 2027, which means that your 2025 premium that you might be paying right now is based on your income from 2023. The reason for this is Medicare wants to start charging your premiums on January 1st, right? But we don't have to file our taxes until April 15th. And even later if we extend our tax returns. So there's this overlap of a couple months where Medicare wants to start charging us premiums, but it doesn't know anything about our tax situations yet. So there's a 1-year lag to this, and it trips a lot of people up. And in Jerry and Elaine's case, they're 63 years old right now. Their income from 2025 is going to impact the Medicare premiums they might pay in the first year that they're enrolled in Medicare. And this trips a lot of people up. So back to our projections and our tax reports here. If Jerry and Elaine decide not to do the Roth conversions, again, modest amount of income, modest amount of taxation, low bracket. Well, part of what our report shows us here are the thresholds for these Medicare premium surcharges. And for married couples filing jointly, if your modified adjusted gross income is below $212,000 this year, Jerry and Elaine are not going to pay any premium surcharge once they get into premiums for 2027. But if they decide to proceed with the conversion, they're going to be at a higher bracket. They're going to be here in the 22% bracket. Their modified adjusted gross income is going to be higher, $236,700. That puts them in this first threshold. They're both going to have to pay an extra $74 per month every single year in 2027. Now, $74 a month for Part B, another $13.70 a month. This is each, not combined. For Part D, maybe you can make the argument that that's not a whole lot of money. But look at how much these go up for every threshold that you exceed after that. And if Jerry and Elaine are considering this Roth IRA conversion strategy, they need to be aware of this, because in this fact pattern, in this profile that we just engineered, their income this year is going to impact the premiums they pay in their first year on Medicare. Note on this one is that your income can also impact what you're paying for healthcare out of pocket before you're on Medicare. So not only does Jerry and Elaine's income this year impact their Medicare premiums a couple of years from now, if they're 63 and they're obtaining healthcare through their state's local exchange, they might be collecting what are called premium subsidies through the Affordable Care Act and their state exchange. The subsidies, the amount that your healthcare is subsidized through the exchange, depends on your income. So if they don't do any Roth conversions, it's very likely that more of their premiums are going to be subsidized. If they proceed with Roth conversions, it's likely that not only will their premiums in 2025 for Medicare be impacted, but their premiums this year will not be subsidized. And the way that this works is when they sign up, let's say that they retired on January 1st of this year, and then they enrolled in healthcare through their state exchange, they had to put in a number for what they expected to earn this year. And their state exchange did some calculations, and then it spat out what the cost, the premium every single month for a variety of health plans would be to them. So if they put in a low number because they hadn't considered the Roth conversions yet, they're not going to pay very much out of pocket for their premiums. But if later on in the year they decide to do Roth conversions of a couple $100,000, when they file their taxes for 2025, they will have to pay a lot of those premium subsidies back. And that can be a very expensive endeavor. So even if you're not of Medicare age yet, or you're before age 63, where your income doesn't impact Medicare premiums, if you're involved in a state marketplace to obtain your health coverage, this can still impact you. Address today in this video has to do with a variety of other credits and deductions. We have a progressive tax system. Here's another example of our tax projection, our report, that shows us the marginal tax brackets. The more income that we have, the higher the rate of tax we're going to pay on that income. In addition to what we're looking at and the marginal brackets that we see here for 2025, there are a whole lot of other credits and deductions that we can qualify for if our income is under certain thresholds. And if we proceed with Roth conversions in a way that puts our income above some of those thresholds, that means that we might not qualify for the same deductions or credits. So here in this example, this is back to our report, it spells out what a lot of these are. And in scenario one, where Jerry and Elaine do not do any Roth conversions, they're eligible for a lot of these. If they want to buy a new or a used electric vehicle this year, they will get a very nice tax credit for that. If they want to contribute to a Roth IRA and they have some earned income, they can do that. If they have student loans that they pay interest on still, hopefully they don't at age 63, but if they did, they could deduct the interest. All these credits, all these deductions depend on your level of income. And if they decided to proceed with the Roth conversions through the 22% bracket, not only are they setting themselves up for higher Medicare costs when they enroll in 2027, but they're phasing out of a lot of these credits and deductions. In this fact pattern, they'd still be able to obtain the credit for new electric vehicle purchases, but not a purchase of a used electric vehicle. They're above the student loan interest deduction threshold, and a variety of others. So depending on your own profile, some of these are going to apply to you, some of these are not going to apply to you. But if you're considering Roth conversions, you need to take this into account, because it's not simply filling up the lower tax brackets now to stay out of them in the future. There are other ramifications, and here is a pretty decent list. That's it for today's video. I hope you enjoyed it. Roth IRA conversions can be a really powerful tax planning tool in retirement, but we need to measure twice and cut once. Years ago, there used to be a rule where you could unwind and walk back a Roth conversion later in the year if you wanted to. That's no longer an option. When you do it, it's permanent. So don't do this haphazardly. It can have unintended consequences. The more your income, thanks to Roth conversions, the more of your Social Security benefits are going to be counted as taxable income. The higher the rate of tax you might pay on long-term capital gains or qualified dividends, the more you might pay in terms of premiums for Medicare Parts B and D, or your own private insurance that's obtained through a marketplace exchange, through your state marketplace. And the higher your income, the less opportunity you're going to have for various deductions and credits that you might be expecting and kind of counting on a year-to-year basis. So measure twice, cut once, and I will talk to you all again soon.